Nice to see a variety of companies. So hopefully a lot of good questions from everyone as we roll through this presentation. We'll try to make it brief and useful, not too daunting with all the acronyms. But it's going to be really interesting. And again, we're trying to make this as interactive as possible. So feel free to jump in the chat at any point. If you have any questions, if you want to pop the industry that you're working with, or if you're a consultant that you are assisting clients with, feel free to also pinpoint the questions to that particular industry as we go, being that on what to report, when to report, and so forth. And feel free to interrupt and raise your hand and put it in the chat. So no problem at all with that. Lockie, do you want to kick off? I think people rolling in.
Awesome. Yeah, fantastic. Will do. Welcome everyone to this webinar. We're really excited to meet with you all and to share a little bit of our perspectives on the mandatory reporting that's coming into effect very soon. I can't believe that it's already October 16th, as I'm sure a lot of people feel the same. And in, I guess, even scarier terms, it's almost 2025 in just 2 months. So, of course, we all know that there is mandatory reporting coming into effect for Group 1 companies, which we will go through and define what or who they are. But also, as you know, the webinar title and all the comms going out beforehand have outlined, we want to really make sure that whether or not you are a Group 1 company, and if you're a smaller than $500 million revenue business, you know what you need to do to make sure that you're ready for any reporting requirements that you have. So just before we start, I'd like to acknowledge the Gadigal people of the Eora Nation, the traditional custodians of the land on which we are virtually meeting today. Afonso and I are in our office here in Sydney in Circular Quay. And I pay my respect to their elders past and present, and extend that respect to all Aboriginal and Torres Strait Islander people joining us today. As we go forward as well, what we're going to make sure that you're very much across are all of the terms and the often confusing pieces of jargon, sustainability acronyms, and buzzwords that you'll hear get sort of shot around. So I'll make sure to put into the chat a bit of a glossary of terms that you'll hear us saying today and what they mean, so that when we are going through things at certain paces throughout today's webinar, you have that to refer back to pinned in the chat. If you hear a funny sounding acronym, you know exactly.
And if we say anything that you don't get, just pop that. What was that word? What was that? Raise your hand, and we'll stop it and kind of move on from there.
Yeah, exactly. So with that, with that, we'll get started. And once again, welcome. Very excited to see everyone here.
All right. This is a kind of a short overview of what we're going over. That overview of the legislation. Why, how did we get where we are? Some of those developments, and then key information. We're going to try and be as specific as possible in terms of okay, this is the overarching thing you have to report on, but trying to actually go in a business day-to-day, what does that mean? What are some next steps potentially we can do? And again, that ongoing Q&A discussion. So not just leave it to the end, but feel free to interrupt as well. All right. So Lockie, you can touch on this, but just a bit of what was approved, the new legislation, what did these imply, and we'll kind of touch on how did this all come together. But overarching, there's now new disclosure requirements in Australia, which apply to different company sizes, and those reporting needs come under a standard published by the AASB. That's one of the first acronyms, the Australian Accounting Standards Board. And so this is really important, and this is like the guiding document that you need to go in and understand. If I'm within these disclosure requirements, what actually needs to be done. An interesting part in that is this verification process. This is not just done internally in a company and then published. It needs to be verified. And then we'll touch on assurance later, but which means, you prepare this information, you get together as a team, your sustainability team, your directors, your board, you write these reports, these strategies, these goals. they need to be verified before you publish and submit it to ASIC. If you're not inside those groups, we'll touch in a second, you don't have to verify those reports, but you need to supply that information, and the assurance of that group one company that's asking you for information might touch on your information as well. Then we'll touch on this standalone sustainability reporting, the core of this piece. It's now a standalone report that exists that you submit to ASIC if you're group one, and then group two and group three. In the meantime, anyone that gets impacted doesn't have, of course, to submit that report, but will have to supply that information to the company that requests it. And of course, the objective, the objective is alignment, is more consumer trust, is, transparency with investors so they can make more informed decisions, and that hopefully overall we are, spending time with companies and organizations and investing money in those who are moving the planet forward or conscious about their impacts on the planet.
Yeah, for sure. And I think just adding to Fonz's points there, with the disclosure requirements, this is not just a carbon accounting and data collection exercise. We'll go through it, but there are other aspects aside from your scope 1, scope 2, and scope 3 emissions that will be requested. And it's really there to make sure that companies have the right policies, frameworks, and procedures set up as well to properly govern their sustainability reporting, and also to make sure that the right checks and analysis are being made. Now, we may even have people in the room who are from organizations where this isn't all that new to you and you're well and truly on top of things. And there is, a reference there to NGA's scheme, and that's the National Greenhouse and Energy Reporting Scheme, which is a framework which has been set up since 2007 for businesses and organizations who have huge emissions, 50,000 tons plus of greenhouse gas emissions, or over 200 terajoules of energy production. So sustainability reporting in Australia is not an entirely new thing, but what we're certainly seeing is that it's affecting a much bigger pool of organizations. And one last thing to touch on there is this does mean that you need to make sure your auditing and your compliance checks are meeting the assurance standards across each of the different scopes that you're reporting on.
And for anyone who is just joining us now, because there's still people trickling in, feel free to jump in the chat, ask questions, tell what industry you're from, if you want us to deep dive in any of those matters. All right, moving on. This is a bit of bunch of acronyms, but how we got where we are. These new standards and kind of disclosures were put up for consultation and feedback. They got a couple of changes in the last few months. They finally got the final sign off when it comes to the standard itself not too long ago, and that's why we're having these conversations, because before we knew it was coming, but people weren't quite sure the dates and the groups and the requirements and what was included. Now that's set in stone when it comes to the standard itself. There's still some things being discussed in terms of ASIC involvement, of pointing the finger if you've done stuff wrong, and a bit of the assurance piece. But when it comes to what it is and what you have to include, it's super defined now, which makes it easier for us to have conversations like yourself and for you to prepare the next steps ahead. We'll provide a summary on those things moving forward, but this is just kind of, this is very recent, September 17th is really just, not long ago. So just be conscious of, it's okay if you feel that this is kind of new because you might not have been involved in that consultation process, or maybe the sustainability team didn't have the resources to go and kind of be tracking the changes over time. So this is now that final release, and it's okay that you're just receiving this information now.
Yeah.
All right, to the important stuff, and our colleague Francesca has prepared this graph. This is a bit of a merging from other people who prepare similar tables and analogies, but it's getting down to who needs to do what and understand where the minimum cap is over the next few years, and we're gonna then overlay our knowledge in terms of when companies do have to report on things like scope 3, how does that impact you, even if you're not on this table as well. So Lockie, do you want to touch on some of the requirements, some of the tests that you can then, we can do it together. Net9 is also releasing a tool that allows you to interact with this table very easily. and we're going to publish it online, which means you can be conducting these tests ongoing at your own time to understand if you change grouping or how other groups coming online can impact your own company. So we'll share that like in the next few weeks as well.
Yeah, for sure. And look, the other thing I think that's really important to highlight here is the changes that have been made in this table or in these requirements from companies of different groupings since July last year when the initial consultation paper was put out. So as you'll probably notice, Group 1 companies are businesses with 500 million of revenue or more, 1 billion or more of consolidated assets, and over 500 employees. Now you can see here in the red writing at the top, you just have to meet 2 of the 3 reporting thresholds. So for example, you may have 500 million of rev. Let's say you've got 501 million in revenue, and you may have 501 employees as well, right? You may not have $1 billion of consolidated assets, but that's all right. You've met 2 out of the 3, so you are a Group 1 company. And the same goes for Group 2 and Group 3. Now, it is important to acknowledge a couple of things here. From an asset owner's perspective, which you can see in the right-hand side, asset owners are scoped out of Group 1. But if you're an asset owner with 5 billion or more of assets under management, you are automatically considered as a Group 2 organization, okay? And then if not, if say you have 4.5 billion of assets under management, you then go back into falling under the regular rules that are set out. And so you might have $4.5 billion of assets under management, but you could be a Group 3 company, or not even if you don't meet the other rules and criteria of the 2 out of 3 thresholds. One other thing that's definitely worth pointing out here is the change has been made to Group 3, which means it's now $50 million of revenue, 25 million or more of consolidated assets, but still 100 employees. It initially in the consultation paper was $100 million of revenue. So there's been a huge change here, and the focus has been, by dropping that by half, has been they really wanted to broaden the scope of the requirements to capture essentially more smaller entities. Now, before you think like, oh, that's unfair and that's now going to affect my business quite a lot, if you are in that sort of edge of Group 3, you would have been asked anyway, and that's their thoughts. You're going to be asked for these same compliant reporting standards off your key clients who may be Group 2 or Group 1 companies. So it won't change too much. Your preparation will still look the same. But we will go into in a little bit, what does preparation look like for this, and what are the right timelines for data gathering and checks and balances.
Again, just to rephrase, this is like who needs to disclose. Now we're going to be diving into like what action needs to be done. But for context, this is like a rolling timeline. So Group 1 has different, will enter that timeline next year, and then Group 2 the year after, and Group 3 the year after that. But for example, in the next 2 years, Group 1 will be requesting information on their supply chain. And most of the teams that we've spoken to are doing that from like day one as an exercise. So regardless, you're going to be interacting with those brands from day one. And you'll have to have, in this case, just emissions data, but they might be requesting things like governance as well, and strategy and net zero plans and scenario analysis, regardless if you are inside the groups. That's kind of why we named this the title under 500 million, because your preparation starts at the same time as Group 1s. Of course, not the mandatory part, but how you interact in the market and with your clients. Again, any questions on this, feel free to jump in the chat and ask, or wait till the end. So what needs to be reported? There's a couple things to understand is that there are 2 standards, and Lockie just posted it in the chat, some of those jargon. Feel free to copy and paste that into your own document. Of course, we'll send it afterwards as well. Steve, you've just raised your hands. If you have a questions, please pop it in the chat. Is that there's 2 standards published. There's a mandatory one and there's a voluntary one. We're going to be paying close attention to that mandatory standard, which is the S2. So if you go online and you follow the links we're going to send you, you're going to see 2 long documents. you want to focus primarily on the S2 if you're just doing the mandatory kind of requirements to do that. And this covers things like materiality, timings of reporting, the metrics, the risk management, the governance, and so forth, which are really important. And we're going to deep dive on how to actually implement them, or how companies we've been speaking with are organizing the sustainability team, the future of the sustainability team, where they sit in the business, how they resourced, and how they can achieve those things. One thing to understand on all of this is, in the past, sustainability reporting has kind of been handed off to consultants, and they are still very integral to the things that we do. The one learning that we have is that companies undergoing this process need to own their data and their systems, right? Because in the future, if you want to overlay any new strategies, you want to change your approach, you want to make sure that your team is empowered to do those changes, even when you bring the external consultant in, because you want to have ownership of the data. So that's like how companies are adapting to now this mandatory and the responsibility of doing this, that they own the data and the metrics, not just the final report. So it's just a nuance on how you think about resourcing your team moving forward. One important thing as well before we move on is that climate scenario analysis. This is new in terms of, it's not just about the metrics and the governance and the strategy. You actually have to map and model the impact of climate on your business. A good example, let's go with tourism in the Blue Mountains. If you own, three, properties there, or, different hotels, and you do tourism in that area, you now have to map things like, temperature increases, more forest fires. I'm going to close those hotels, 1 month every year, that I won't accept any bookings because, there's fire alerts in the area, or there's too much smoke, and so forth. And you have to model the financial impact of that climate scenario. And this brings a lot of challenges for teams to understand, okay, how am I impacted by climate? And this doesn't have to do with total emissions. It needs to be, about how you get impacted with this new modeling.
Awesome. If we jump to the next slide.
Yeah.
So yeah, importantly, looking at what's included and what's not included. So from an inclusions perspective, we already spoke before about the metrics and targets that are going to be required from a climate-related risk and opportunities perspective. We know as well that there is the scenario analysis, which Afonso just correctly pointed out. We also need to be looking from a risk perspective, but also the strategy and the governance piece is a really important one that businesses need to consider. You can, of course, do your analysis and understand what your footprint is and where all of your data sits, but you are required to also engage in that more qualitative piece with your board, with your key leadership, to make sure that you're covering off how you're baking this into your plan. In fact, there even need to be disclosures from your senior leadership on if there are KPIs or performance metrics built around your sustainability performance. So this is definitely shifting from a part of the annual reporting that isn't necessarily given as much airtime as some of the other areas to now actually being something that's KPI'd and metriced against. But Fons will go into a little bit more detail on each of the governance strategy and market.
Okay, do you want to just pop the glossary in the chat if you can, and make it to an everyone conversation?
Yeah, I'll set that up.
Yeah. One point as well is just that quality of information versus without quantitative is if you want to make and this will come back on how ASIC is going to point the finger if you've done something wrong, is about if you're going to propose a plan, and then of course there's some kind of protection in the first 3 years for directors when they sign off. You still want to make claims that are based on data. So you might have to step back on what you can state, as long if you don't have any information. If you do have, you can go all in and exemplify and strategize how you're going to achieve certain targets and goals within your company. So what needs to be reported inside governance, of course, is the first instance is actually sitting down with your board and understand who has oversight on what, that management roles and who's involved in taking leadership on different areas. And of course, that performance metrics and remuneration. These are things that don't necessarily require carbon accounting software, or you need carbon intensity metrics. It's just about sitting down and understand, let's strategize of what is material to us, what we care about, and how we're going to structure this within our business. For smaller companies, it might fall, in just a couple of individuals. For larger companies, you might, try to understand that there's a lot of people involved to make these decisions. But this is sitting down, booking the time, doing it every quarter and start having those conversations. Moving on to the next point is in the strategy. So in the strategies is, like I said, is that like planning of what you're doing moving ahead and how you're going to achieve those goals. Again, it's on normally the second step, and this can be circular things, is understanding how we're going to deploy the things that the board agree as material. So a good example is understanding that climate-related opportunities, this might be, how we're going to pursue a different product to market or a different area or different service, strategy about decarbonization, the impact of the value chain, and of course, that climate resilient analysis, which is super key. Again, understanding how am I exposed to changes in climate on the way that we operate. You might not think that, you have an extreme exposure to climate, but if your suppliers have, like, your server provider or a material provider on how often they can ship stuff, that will actually impact your financial performance. And that's what investors care and want to understand is what is the risk that I have by investing in this business. All right. Finally, as a second last step, we have over here that risk, right? And this is more about like managing processes. It's not that you're going to be voided of risk. And again, this is all quality information mostly, but understand how you're going to monitor those opportunities. And this might be a quarterly process, might be how you source information, might be about the policies that you approve inside your systems. And then comes the data-driven approach. This here should be, the metrics and targets. It's now your scope 1, scope 2, and scope 3 greenhouse gases. It's about that reporting. It's about that, carbon prices. It's about other targets like net zero goals. And this is normally why you need to be very data-driven in this approach, because you want to systemize this. Now we're going to step away and give like a practical scenario on how you go and achieve this. You might have done parts of this before. So we recommend, if you've done it in the past, is about like systemizing the process with the end goal that sustainability as a recommendation sits within different units of your business, where it becomes, business as usual to feed data into these systems to provide the reporting. You want your team, your sustainability team, to think about that strategy and risk, not just be gathering information to do your climate-related metrics. So you want ownership of providing activity data, intensity data from the different business units and consolidated information. And circling back on the last point, you want to own this data and this system. Bring your consultants in to help you out, map it in the first place, to do the first run and passes, bring your softwares in. But at the end of the day, you need to make sure that you can access it, that other people can see what's happening behind the scenes. Your auditor will need that information. And that's why it's important to bring that ownership into this.
Yeah, I think it's really important to sort of take a pause and really dive on that last point that Alfonso mentioned. It is very, very, very important for you as the leaders within your organization to make sure that you do have and maintain that control and ownership over your data systems and not just the reports. We know that the reports here are, the shiny thing that is the reward and the end outcome that you need, but you need to make sure that for future years, you stay in control of the oversight of your supply chains and the oversight of your operational impacts, so that you can be the ones to look at where those changes can be made without being reliant on whoever produced them. So yes, you want your reports, but also make sure you have all of your data books and information in your control as well.
And this goes in line with other things that are happening. Like, if you look at like nature at the moment, right? Nature is built, or nature reporting is built on top of your like climate reporting. So understanding where the data lies, so you can then like overlap the strategies or overlap the impact on how your assets are exposed, is important. And you can only do that if you understand where your data lies. So we highly recommend it, like mindset of sustainability being embedded in every unit, in the ownership of those processes. So it's totally fine to kind of upskill your team to understand well they'll be sitting and kind of bring everyone on board to achieve kind of that seamless experience.
Yeah. And so I guess like that dovetails pretty nicely into the next point, and something we get asked a lot about is, what does a seamless experience look like? And from a data collection perspective, what is acceptable data to collect? What are the reasonable assumptions to make? What are the levels of assurance that I should be making sure that I'm hitting? So I think starting with the first point, it's making sure you understand what is meant when we talk about assurance of data across both Scope 1, Scope 2, and Scope 3. So you have two forms of assurance: limited assurance, which is referred to as a lower level of confidence, where the auditor reviews the company's data in slightly less depth and aims to really identify if anything appears incorrect or misleading, but without an exhaustive examination. It often will be looking it would often be described as negative assurance because the auditor concludes that nothing has come to their attention that suggests any real material misstatements. Reasonable assurance, and which we'll go through, is where everything's heading for. And it's a bit crazy to think that the plans around reasonable assurance are for companies to be across Scope 1, 2, and 3 reasonable assurance by 2030, which Afonso and I were talking about before is not actually that far away anymore. But reasonable assurance is, on the other hand, a much more thorough review where the auditor seeks to obtain sufficient evidence to express positive opinion that the data is free from any material misstatements. So there are two sort of levels of assurance, both limited and reasonable, and I'll also put those in the glossary just so we have them. We need to first make sure that our data is meeting our assurance requirements for those specific verticals that they're in. And then we need to secondly make sure that we've got the right data and we're making assumptions where necessary in the right places.
And one point as well that comes to that ownership is like some of the assurance, understand like how did it come from, thinking about like, vehicle fuels and transports, like understanding, so you can like speak with the auditor in terms of like, how did you originate this data from and what's the source of these emissions. It's kind of really important to facilitate this process. So Dayton had a question, which is, what if you're a sub-entity with parent entity in Europe? Can you report the consolidated results? You are under this, and we can send more information afterwards, if you have to report under like the Companies Act. So if even you might be listed somewhere else, but you don't have to report. If you have to report under the Companies Act, regardless if you're a sub-entity, you need to comply with these regulations. Which brings to the point of, this is very influenced by AASB, so it might be an easy transition if your European entity already does so. If not, you might have to kind of revamp the internal reporting, even if you're doing a CSDR, to adapt to what is happening in Australia. So there's some small nuances, and we can touch on that later. But most likely, if you're under the Companies Act, you have to create this reporting. Which brings some of the timing. The timing of this is that financial calendar. So if you have other reporting needs that are like yearly, you will need to submit your sustainability reports in this fiscal year ongoing window. Yeah, which is, Mark just asked that question just now, nice segue. We're in Group 2, so reporting starts July 2025. However, our financial year is January to December. When will our first sustainability report be required? The period that report will be the financial year, so most likely will be that July.
But it's just worth noting for you there, Mark. So as a Group 2 company, your reporting will now be January 2026. Not July 2025. So July 2025 was the initial date. It is now January 2026 for Group 2s.
So your report, you're going to be measuring those metrics from those from that period, like 12 months. So from your data guide from like July 2025 to June 2026, and report them.
Yeah.
So your exercise starts today, Mark, in that sense of like trying to visualize how next calendar year you're gonna be capturing this data and this information. So we have a bit of a timeline at the latest slides, but those conversations and what's happening and how you sit down with the board need to happen today to strategize that exercise.
And I do just think it's worth, and we will send this around afterwards, but it's a good point that Mark made. I think it's worth going back to this slide here, which, as we can see, and as outlined a little bit earlier on, there have been changes, of course, to not only the definitions around different groups, but also the timelines for these groups. So as we can see, Group 1, first annual reporting period beginning on or after 1st of January 2025. And then, as you can see, Group 2, July 2026, and then Group 3, July 2027.
All right, so moving on to when to report. Like I said, this is a lodgement made to the ASIC that there's annual reporting to be done. And finally is that first year reporting relief. There's not much relief in that first year. It's not applicable under the ASRS. Go back to the glossary. But there is some relief in terms of the director signing off, especially on forward-thinking plans. You have a 3-year relief in terms of being held accountable to the plans that you're setting for your net zero strategies moving forward and so forth.
So I think at this point, Fons, it's good to speak about what good looks like, because I know certainly from speaking to lots of our clients and partners that it's sometimes hard to understand where you sit in comparison to your competitors or your industry, or even just knowing if you're ahead or behind of what good looks like. So from a reporting perspective and the frequency and timing, what do you think businesses should be organizing right now to make sure they're looking like good, or they're looking better than most?
Yeah, we'll touch on, I guess, that question as a question of by industry, because materiality comes into play a lot. So first is regardless if you're in Group 1, Group 2, and Group 3, is about materiality by industry. Even though there's no industry guidance, you do have to do that materiality assessment. So when we look at things
can you explain the materiality assessment for the
it's understand what is relevant to your business. Going up, sitting with your board, and not only understanding that exposure piece, but things that you want to pursue afterwards, things that you're most financially dependent on. So it might be supply chain or a specific supplier might be material to you because they actually source 80% of your material to manufacture something. Maybe you hinge on certain partnerships, certain regions, and so forth. So doing that together. So if you look at emissions as an example, we work with a range of companies at NetNada, and we know that looking at your scope 3 as an example, if you're a professional service business, by default, mostly you'll be doing your category 1, 2, and 7. So a good example: purchase goods and services, capital goods, employee commute, and so forth. Well, if you're looking at managing assets, you're looking at the category 15. If you are manufacturing goods, the ends and the disposable of those goods is really important and really core. It might be material. So there's some nuances to be good by understanding what's material and making sure that you're being relevant to what your business is. Because at the end of the day, you're trying to provide valuable information to the public and those investors, and you're producing all these goods, selling it to someone, and they're super hard to dispose of, and is actually creating a liability there, and you don't report on that risk of, for example, not having a waste stream that can take on that product you are putting into the market. It might be seen as that you missed out on that materiality assessment. The other thing is what good looks like. What we see, and by being in the consultation processes, is that companies that, especially Group 1 companies that didn't prepare ahead of time with that governance piece, are now scrambling to get the resources and to understand what's important for them. So regardless of where we are doing that qualitative part, which is sitting down and understanding how to move forward and maybe doing some trial runs. So let's say you're in Group 3, start doing your emissions reporting, doing it now, because you're going to improve over time. And by the time that's mandatory to you, you are prepared and you've done it before. Anything you want to add on that?
No, not really. I think it's just the summary is, you have to report on scope 1 and 2 emissions, every business, and then depending on the business and the industry that you're in and the business that you run, the scope 3 emissions categories. So there's 15 categories under the greenhouse gas protocol. which split up all different activities that a business will make. Depending on the industry and business, the industry you're in and business you run, you'll have to report on the material categories, as Afonso pointed out, which will differ between business to business and industry to industry. So if you're a producer of physical products, you may have to be considering the end of life, downstream treatment of those sold products, and also the downstream transportation and logistics. Whereas, say, if you're a professional services business or a tech company, you may be more focused on just, what are your purchase goods and services, and what are your maybe investments that you're making or something that's more material to your business.
One question we just had just now, like, what's the cost of non-compliance? ASIC is still defining, what non-compliance looks like. Most likely will be, aligned to what currently happens in the financial aspect. There is one other part of this which is coming from like AAASB, which you now see actually the first, greenwashing cases, which serve as like a baseline when it comes to like the consumer aspect, the product that you're selling, how you're labeling that, maybe in some of your statements, and if you entertain it with marketing, where you can start getting a bit of a sense of some of the penalties or the cost of non-compliance or over stating some of your plans or some of the products that you sell.
Yeah, of course. I mean, look, this is all governed at the end of the day by the Corporations Act, and under the Corporations Act, you'll see fines that are ranging over $10 million for civil penalties for companies when they either have insufficient disclosures or misleading disclosures. And then, of course, from a director's level, you may have up to $1 million fines per breach as well. So there's cost for non-compliance, both for the organisation and, of course, for the individuals and directors within the organisation. Those costs, range based on the severity of the non-compliance, but $10 million is quite a lot for a business, and $1 million is certainly quite a lot for an individual.
Yeah, and this is what we touch on in terms of that compliance. Some of the processes, the lodgement to ASIC, that public availability, that standalone sustainability report that now is going to have a lot of eyes on to make sure it's compliant, and some of the nuances in terms of like reporting periods, financial year versus calendar year. If you already reported somewhere else, we can deep dive in the information after, because it's really company by company. And if you have any questions on the applicability to you, I think it's better off that you reach out and we have the conversation instead of just trying to give you like a one size fits all. Some things are like set in stone. Some things you have to read in between the lines to understand how they apply to you, especially in the reporting periods, if you have to do double reporting, if you are considered like a sub-entity or not, if you're listed in the ASX market versus overseas and so forth. And then that nuance about asset managers and how they go into the different groups. Hope that answers your question in the cost of non-compliance. One thing that we're touching on before is just, we're getting to the end, conscious of time as well. It's an iterative process. That's why we recommend reach out to your consultant, reach out to your software providers today, reach out to your sustainability team today, and start going through this process. The other thing is like maturity levels, the journey that, is fitting into a company that's been always in the spotlight of sustainability, like, a forestry company or like, energy company, is not the same expectations, in a different maturity level of your own company, but know that the requirements are the same, right? In terms of like, regardless of what industry they are or not, but people are expecting different things. And finally, that cross-functional collaboration is, we are seeing that the future of sustainability is being embedded into the system, where sustainability teams manage a budget, they're managing strategy, they're managing risk, so that linkage between sustainability, CFOs, finance makes sense. And we're seeing this being brought together by, the financial and non-financial disclosures now being so intertwined with each other.
Yeah, I think just adding to that, and your key considerations when you're planning for this is, as an organisation, say you're sub 500 million and it doesn't feel like something you have to do right now. What I would be looking at would be making sure that I'm covering all of the areas. So of course, I hope today has helped frame it that, you do need to consider your governance, you do need to consider your strategy, you do need to consider your risk management and your metrics, your targets, and also your scenario analysis. So that might be a little bit more than you originally thought. You may have seen the more attention-grabbing headlines of Scope 1 and 2 emissions reporting required, Scope 3, coming down the line. Well, no, there's a bit more to it than just that, and I think it's very important you're ready and aware of that. The second thing is also understanding what's material to you, and not just from a materiality assessment of what you need to be analyzing, but also a materiality assessment of what you need to be gaining assurance on, and that your auditing partners need to be making sure that they're checking over correctly. So it's a simple process if done right, but it's about getting started at the right time. So the next thing we get asked all the time is, how long does this take, and what do I need to do to prepare? So hopefully this next slide helps out.
Yeah, and again, conscious of time, like if you have any questions now, feel free to ask them so we can quickly answer as well. We're gonna send this kind of next steps slide across as well, because it's really important to understand how you developed those decarbonization strategies, that scenario analysis, and we'll try in the next few months to build this resource bank to understand how do you actually conduct the scenario analysis based on the standards, based on recommendations, but putting into useful tools that you can implement internally. What does it look like to have a good climate risk and opportunity assessment, and make sure that's it's based on meaningful things that you can implement and tools that you can distribute across your company, and try to be less up in the air. This is what you need to do, but this is how you actually get done, and here are the tools to do so.
Yeah, awesome. Look, I see a question in the chat that's very relevant to this slide. So, in directly responding to that, we have not even started with any of the mandatory reporting requirements. How long is it going to take, and how much is it going to cost me to do this? Very, very good question, and very common question that we get. So of course, it'd be remiss of me not to say it does depend on your organization. Okay, how large is your organization? How complex? How many sites are we looking at? How much data are we pulling in? Are we comparing different countries and using global data sets, or is it just an Australian organization? So there's a lot of factors that would change, how long, or also how much something like this would cost. It could be anything from, let's say, 10 grand all the way up to 500 grand, depending on how complex your business is. But hopefully it's down the lower end of all of that. From a timelines perspective, within the first 1 to 3 months, as you can see here, we're starting to sort of establish how your company is looking at sustainability, what your goals are, what resources you're going to put towards it internally and externally, and also defining what good looks like for you. Okay. Once you've done that, you get your analysis done, you start to understand where you sit, and you can start to take those short-term actions. Make sure you start refining all of the data that's being collected, making sure that it does meet all of your material requirements. And also what I would say is, in preparation, you want to give yourself the chance to, get a year under the belt before it comes time for you to have to provide it. So, if you are a Group 1 company in this scenario, then it's a little bit too late for that. But if you are a Group 2 or 3 company, you might do a year's of analysis. So you see, okay, this is what it looked like for us. This is how much time and resources it took. And next year, these are the areas where we want to make improvements or refine on data. You also will then be able to identify any gaps or any areas where you see that there are material pieces of information that you don't have data for, especially in your Scope 3. But what we'd like to say is, in the first few months, we could turn around a report for you, which you could use for your disclosures. But sustainability is certainly not something that ends with a report. I think it's very important to note that this becomes an integral part of your business, and hopefully becomes a part of your business that's actually a strength. So it's not the approach of saying, here's a report, after 1 to 3 months, off you go and you've met your compliance requirements for this year. It's certainly the case of saying, how do we improve from here? How do we do better next year when you're going to be asked for it again? And
if you're approaching that today, we know we can give you that emissions report, within a month, and depending on the size of the company and how you want to do that. But it's how can we help you do everything else? How can we help you establish the governance? How can we do the scenario analysis with you. So you make sure it's not just about those emissions numbers, but about more than that. And how can our partners support you achieve that if need be? We are on time now.
Great. Any other questions?
If any other questions, please pop them in the chat. We'll send all this information and recordings across. Our contribution as a community is super valuable to us, and we're here to help. We consider ourselves the most approachable founders in the industry, so feel free to reach out to us directly. And our team are here to help out. This is a journey to be done as a team, we believe, because we need to learn from each other. So feel free to bring us in to have the conversations with you and your colleagues, because we are here to help.
Awesome. Any other questions in the chat while you've got us?
I think that's all. All right. One question coming in.
For those who are only about to start, what is the most important tool to collect and analyze data for compliance? I mean, I would have to say the most important tool would be, internally agreeing that it's, getting internal buy-in. You can use any software or tool you want, but if you don't have the internal buy-in and
same approach, either if you're doing this with a consultant, Excel spreadsheet, with a tool that automates the process like NetNata, your first barrier is getting the buy-in in terms of like who's going to participate in that, and we can facilitate that discussion. But definitely, we want to systemize the process and for you to own the data, so tools make sense for you to have that data in a place that everyone can access across the business. Great question.
Yeah.
And remember, the compliance involves auditing, so being able to provide the data to an auditor and so forth really helps out.
I think as well, like it's maybe not so much a tool, but it is important as a first step to understand, based on your business and your industry. I know I say that a lot, but knowing where you should be looking to collect data that's relevant for your business. So I'll definitely flag that as something.
Thank you so much, team. Thanks everyone for participating, and we'll see you next time. Any questions, feel free to send us a direct message. We're here to help. Thank you.